Welcome back to Insiders Capital. I'm your host, Pierre Daillie. I have got a fantastic guest lined up, someone who brings serious energy and insight to every conversation about investing. Joining us is Shana Sissel, the powerhouse CEO of Banríon Capital Management. They call her the Queen of Alternatives, not because it's catchy, but because she's built an entire career turning complexity into clarity for advisors who dare to go beyond the 60-40 mold. From her early days as a Morgan Stanley advisor to leading investment due diligence at Orion and managing a $500 million portfolio as CIO of Spotlight Asset Group, Shana has lived every corner of this business, retail, institutional, and everything in between. But in 2022, she decided to flip the script. With Banríon Capital Management, she created the first open architecture platform built by advisors, for advisors, a space where alternative investments finally make sense and scale. She's a regular on CNBC, Bloomberg, and Fox Business, a top 20 wealth tech CEO, and a relentless advocate for innovation, diversity, and education in wealth management. So today, we're not just meeting a CEO, we're sitting down with someone who's redefining what quote unquote alternative really means, not as an asset class, but as a mindset.
This is Insiders Capital. Join us in our fireside chats with some of the most fascinating people in finance to discuss their insights on life, markets, macro, investment strategy, and much more.
Shana, welcome. It is great to have you with us.
Well, that was quite the intro. Thank you so much.
Well, it's well deserved, Shana. Thank you again for joining us here. It's great to have you. Shana, you've built quite a reputation in this industry. But let's start with your story. How did finance first find you, or did you find it? What was life like in those early days for you?
Well, I guess you could say it found me because I certainly wasn't looking for finance. I have an undergraduate degree in sports management, and I think on a previous episode we went deep into that. But my goal was to work in the professional sports industry. I wanted to be sideline reporter for ESPN. I had worked for several professional sports teams, and that was kind of my career aspiration, but it didn't quite go that way. I ended up working for a staffing agency right out of college as an account manager, and we had a client, it was Morgan Stanley, that was looking for us to send them candidates for their financial advisor training program, and we sent them a lot of candidates and none of them were being hired. So my boss really wanted to better understand what we were missing, and since the account belonged to him and not me, they didn't really know me. So they sent me in to interview and see if we could get any insight into the interview process and why we weren't having any success getting candidates placed there. And it turned out that I was the type of candidate they were looking for, because they did offer me the job and they offered me a substantial raise compared to what I was making at the staffing agency. So ultimately, at the time, I took the job thinking, well, it's just going to pay me better so I can work towards what I really want to do. But I ended up really loving financial markets. And so I began pursuing a career in finance. I did realize pretty quickly that I enjoyed finance and in markets and learning about investing and building portfolios a lot. I really didn't like the part of being a financial advisor, which is the bulk of the business,
Right.
job, which is sales and looking for new clients. And at the time, that meant cold calling, and that really was not for me. So I found what I loved, just not in the flavor that I liked it. So ended up pursuing an MBA, and then I've been in finance ever since.
Fantastic. What a great story. I think you just sort of accidentally happened into the business because you did fit the bill, and, it wasn't even something you were looking for. I think that's remarkable. And yeah, I tend to agree with you that as a financial advisor, you have to wear so many hats. There's so many different roles you have to fulfill. You got to fulfill the business development role. You have to fulfill the marketing role. You have to fulfill the admin role. You have to manage a team if you have people working with you, alongside you. So it's definitely a very, like, for financial advisors, it's a very time constrained business. And there's parts of it that are, that if you're introverted at all, just makes it very hard. And, the interesting thing about introversion is that, extroversion is mostly cultivated. And some of the most successful people I've ever met, in my case, were introverts, but they cultivated this attitude and way of doing business that was completely like alter ego. And it's a stretch. It's something that takes a lot of work. And there's so many, and this is such a great business. There's so many aspects to this business that are fascinating and ever changing on a daily basis. Just when you think you know something about the business, you realize how little you know.
Oh, absolutely. Absolutely. I consider myself an introvert by the actual formal definition of introvert. I know most people don't see me that way, but introvert just means that interacting with people can be a draining experience, whereas extroverted is the opposite. It doesn't mean you're not good at interacting with people. It just means that at the end of the day, you either want to be around people or you don't. And I'm somebody who, when it's 5, 6, 7 o'clock, I don't want to be around people because I'm around them all day and I'm interacting all day. But to your point, it is an interesting job. I always say financial advisors do the Lord's work because it is a very difficult job. And I'm not sure they necessarily get the respect of the fact of how difficult that job is, because I feel very much like it's very soft skill. It's very EQ, not IQ oriented. And because it's not IQ oriented, but it's in an IQ industry, they get looked down upon. But I actually think it's the EQ that they do so well that makes them successful. And that just being different from the vast majority of the rest of the industry is why they kind of get looked down upon. But it's just a different skill set, but a valuable one at that. And so, from my standpoint, it wasn't necessarily for me, but I have the utmost respect for the job. And I think what makes what we do at Banríon so different and why we kind of stand out is that we did the job.
Right.
And when I look at, the competitive landscape of folks kind of doing alt solutions, the vast majority, even the new ones, every day I feel like there's a new one coming out. And recently saw a newer firm being launched that kind of bills itself similar to us. Went and looked up the founders, and sure enough, the founders were all former PE guys. And I just think that difference is substantial. If you've never actually done the job, no matter how much you think you understand it, you don't. And it's that coming at it from that EQ, IQ perspective. If you didn't sit in the job, you don't come at it from the EQ perspective. You will always come at it from the IQ perspective. If I just give them the best product, if I just give them, the slickest technology, if I just have the best resume, then that will be why I win. But at the end of the day, without understanding the EQ part of the business and the tools being built for that market, then you're just doing the same thing as everybody else that came before you. So when we built Banríon, it was really to be an advisor-centered solution. I do believe that most of the competitors in the space understand that there's a problem that needs to be solved for the advisor, but because they don't understand the job, they come at the solution from a perspective of an outsider. And that's why none of the solutions really stick or solve the problem completely. And that's why we tried to do something different. And everything we do at Banríon is about solving the advisor's points of friction from the advisor's perspective. And everything we do is understanding that it's a relationship-driven business. So the solutions we provide have to be based on the fact that it is building and growing and developing those relationships. So no matter what we bring to the table, how good the product is, we want to have good product, everything. If I can't make it work in that relationship management approach and that business development focus, it doesn't matter.
It's kind of wild when you stop and think about it. Like I've we've spent a fair amount of time looking over the value of advice, Vanguard's Advisor Alpha, Russell's value of advice equation. And one thing, just from what you were saying, one thing that you sort of highlighted there was the fact that if you haven't done the job, you don't know exactly like what it does to you.
Mm-hmm.
First of all, like how the gymnastics that you have to do to bridge the gap between institutions and clients. And that's where, of course, if you have people who have spent their whole lives structuring product or putting together deals and never having actually dealt with retail clients, it's one thing to get the advisor on side with an idea, a strategy, a fund, something alternative. But it's a whole other thing for the advisor to then take what they got and transfer it to the client.
Yeah, I think
Right? You have to make it relatable, and that's the part. Like if the point I was going to make was that advisors take their value for granted.
Mhm.
They don't realize and what I was going to say was missing from advisors alpha and value of advice at Russell is that factor, the experience of having to bridge the relationships between institutions and clients and managing everything that happens in between. Now you've done all of that work. I as well have 15 years as an advisor, 5 years as a wholesaler. So when you come at it from the experience of having been an advisor, you lend a perspective that none of the other parties can lend most of the time, unless like in many cases, wholesalers are former advisors.
Yeah, so in the 25 years I've been in the business, I spent, let's see, 3.5 to 4. So what is that? 10 years of the 25 in a role where I was working either as an advisor or at an RIA, dealing with those clients. And I think the point that gets missed is there's two things that folks who come from the product side do really well. Number one, they do bring good product or, the highest quality product in some sense. They understand that, brand matters and things of that nature, and access matters. And they package stories well. The problem is a lot of times they package stories for bad products because they can sell it and they understand the advisor needs the product. But what I think they don't do well, and I think you cannot do well unless you've actually sat in the seat, is understanding that the business and the relationship between the advisor and their client isn't about, did you give them the best product? Like, did you pick the best fund? It has nothing to do with that. It's, yes, you have to be able to provide them and have access to all the same product that any one of your competition does. But really, you're never going to get fired because you gave somebody, the second best product or, the product that worked in their portfolio, because it's all goal oriented. If the client's on track to meet their goals, that's really the key. It's not,
Right.
Did you beat the S&P by 25%? Like on the institutional side, that matters to some extent. It matters for the awards. It matters for the packaging. But ultimately, for the advisor, that's not what it's about. The advisor and their client, it's about helping them meet their goals and doing it in a way that is able to make that client sleep easily at night. So the journey should not be bumpy or substantially bumpy. And number two is understanding how whatever you put in front of the client needs to be driven to better understand the client's relationship and to retain that client. So having a flashy, good story is all well and good, but if the story is packaging a bad product, eventually that's going to cause pain in the relationship because the advisor is going to ask questions they can't answer. Right. And then they're going to, whether or not the product was amazing or not, sell the product because it just becomes too tense within the relationship and they don't want to lose the relationship. So a lot of times, it's about packaging. Then the other problem is understanding that in a competitive world where there's so much pressure on the advisor to maintain lower fees and really justify their value proposition. How do you do that? If everybody can offer the same thing, how do you find the right thing that's unique in a way that can both be a good product and provide the advisor some way to stand out from the rest of the competition? And, there's ways to do that can be product focused, but you have to be open to looking at different structures and different managers, because I think we live in a world where brand, especially in finance, is not always the best thing. I think we're learning more and more that individuals are more reluctant to trust slick branding and big brands. And so you have to think about, our industry is full of a lot of smaller boutiques, which I would argue might be better fits for the advisor market because they're not trying to be everything to everyone. And they're very focused in their solution, and they're looking to raise billions of dollars of assets. They're not all chasing one small investment opportunity. And I think all of those things matter. And so Banríon has really been focused on being structure agnostic and really being open to really any manager or any asset management firm out there that passes our operational due diligence hurdles.
Right.
So we're not really focused heavily on, they have to be 100 million with 3 years track record. They have to, be a name that everybody knows. That I think is really a lazy thing. I don't want to do the work. And because they're bigger, I can just, rely on the fact that the regulators have oversight and whatever. And yeah, there is some risk there when you go to the smaller firms that maybe aren't as well known. But if you're willing to do the work and bring those things to the table and give those opportunities, I think that you can find things that will help advisors find specific products and solutions that can really serve their client base in a unique way. And there's no shortage of opportunities out there. So, every advisor can find something that's a good fit for their client and a structure that works for their client. You just have to be willing to, look at a broader universe, and really find ways to help advisors find things to help them stand out while also maintaining that fiduciary responsibility and doing that, due diligence operationally from an oversight perspective to keep them out of trouble. And, that's what we aim to do at Banríon.
Yeah. I mean, there's in the alternative and private markets, there is an incredible abundance of opportunity that most investors aren't even aware of. Mm-hmm. And I to your point, I think, you mentioned just in passing, you said, doesn't have to be $100 million with 3 years of track record to get looked at. Problem is often it's the gatekeepers, right? The gatekeepers have a sort of cookie cutter mentality to allowing or disallowing even a review.
Well, that's where I say that's a laziness factor. I want to, if I wait to this point, there's some cover, and it doesn't require me to put as much of my own reputation on the line or do as much work. I do think one thing that I like
definitely cuts the short list down. Right?
Yeah, it makes it easier from that perspective. But there's another thing that I think is worth noting. We deal with this every now and then as we work with different firms, and it's not necessarily a bad thing, but I do like to remind advisors, larger firms would prefer not to deal with smaller tickets. If they're trying to raise $100 billion fund or, $500 million fund, right? And they have a year to raise that fund. Like the $250,000 ticket and the amount of work that went into getting that $250,000 ticket is not worth the squeeze for the juice. And so if they're willing to do that, if that is something they're willing to do, you have to ask yourself why, because most firms would prefer not to deal with those size tickets. And we've certainly had partners that have come in and said, oh, we're fine with that. And then realize oh my God, I'm doing so much work and we've only raised $5 million. Yeah, it's been a bunch of tickets, but it's all been 100,000 here, 250,000 here. And for all the paperwork and all the lift that goes into that. If I can't do a feeder through somebody else or have somebody else deal with that and just write me the one big ticket or like the registration differences and things of that nature and the cost associated with them, you have to ask why they would come into that market and be willing to take those tickets and go through that. Is there a reason? And that's why I say sometimes those smaller shops, those smaller boutiques, I'm only looking to raise $50 million or whatever it is. They're grateful for those smaller tickets because they don't need or want the bigger ticket. They don't want the concentration in these products that aren't raising a ton of assets. And so they tend to be better product. If a large firm has come to the point where they're willing to accept those smaller tickets and willing to take the hassle that comes with them, there has to be a reason behind it. And not all the times is it nefarious, but I would say more times than not, it's because they don't have the ability or a product worth marketing to the businesses, to the clients and the investors that can write the bigger tickets. So it's just, things you need to kind of think about when you're evaluating these opportunities.
So you're bridging the gap between also, the institutions and the dealers, right? And how do you, so you're alleviating, you're taking the burden off the compliance department?
Not necessarily off the compliance department.
Do they look at, like, even with some of the bigger RIA platforms, advisor platforms that are out there, are you providing, is it kind of like a way of bridging between these smaller issuers of deals and opportunities, alternatives? Are you making it possible for the bigger dealers to say, okay, Banríon says they like this particular dealer? Is it that you're on the dealer's shelf, and then within you being on the dealer's shelf, so are some of these smaller shops?
So
How it works?
So somewhat. So I want you to think of it this way. I'm going to kind of come at it. And we've been talking about how we support the advisor. Let's talk about how we support the asset manager, right? Because I think that's unique. So unlike most other folks in this business and that offer these alternative solutions, we are not incentivized to fundraise. And that was an important caveat that I wanted to bring to the table. But if we're not incentivized to fundraise, we have to add value some other way. So the way that we add value to our asset manager partners, and some of them love this idea and some of them think they do, and then once they get in it, they're like, but wait a second, I thought you were going to help me raise assets. And we always say, well, yeah, we are, but we're in it like for the long haul. So we're providing you all the tools you need to expedite and come to the table when you meet with an advisor ready. Right. So that means.
So when the advisor says to the asset manager, "Are you on our platform?" the answer can be yes.
It might not be yes, but at least you have everything you need to be platform ready. So what I mean by that is, so we help our asset manager clients go through a due diligence process, which we do with them. And then we do it at arm's length. So we don't necessarily recommend, we just go through the process. So we will give them a due diligence questionnaire to fill out. And oftentimes, some of these managers have not ever filled out an advisor due diligence questionnaire. And I'll go through it the first time, they'll send me the return, and it's a mess. Right. So if they were to go directly to the advisor without us and do their due diligence questionnaire and send back what they send me, they would never receive a phone call again. Like they are already like moved out of contention. And so we'll sit down with them and be like, okay, let me tell you all the reasons why we need to fix these answers or better understand what they're trying to get out with the questions that they're asking, and make sure that they go through that due diligence questionnaire exercise. And the final outcome is advisor ready. And a lot of times it's not the first time around. And so we help them through that. And then secondarily, once we've gone through that and done our operational due diligence, which is checking their third-party vendors, their legal counsel, all that good stuff, checking a number of different operational due diligence hurdles, we've completed that DDQ, and then we do a due diligence report, which helps the advisor, because the average advisor doesn't have like this huge legal team that's doing those DDQs. So a DDQ to them is just a legal document that looks, no matter what, sufficient, even if there are some red flags in it. So then we take that report and then we do a DDR, due diligence report, for the advisor, but not with the intent of saying, I love this fund, this is a buy, this is a sell, this is a hold, or a rating, or anything like that, but more in the intention of, let's take everything that was in the DDQ and kind of reduce it to the most important parts so that you have the consistent output of, I know when I read this report, like the first 2 sections are going to be on, the team and their background and all of their background checks. I know that, what their business continuity plan is. I know how they do compliance, operations, trade, execution, all that kind of stuff. And then the second part's going to be, this is what the product is. This is how they manage the product. And this is how you might use it in a portfolio. This is how you set return expectations. And this is kind of all the things that you probably should be aware of to prompt conversation with your client about, this isn't fully liquid, so you want to have a liquidity budget conversation, and this is how you would do that. Make sure you talk to the accountant or have your client talk to the accountant. There may be some tax consequences to this, things of that nature. And so that's what our DDRs are. And our asset manager clients, once we're completed with them, in the same way that they might pay some other firm to do those exercises for them and then give them to the advisor, we give them to our asset manager clients as part of our services so they can use them with any advisor. So to your point, if they were to go to a large REA aggregator, for example,
Right.
a lot of those firms have backlogs on due diligence requests. They're able to go there and hand them the due diligence packages that we've completed and be like, Banrion's completed this. Because we're not incentivized to fundraise, we don't have a conflict of interest with the output of those due diligence reports. So, let's say Robert Picard, for example, who's the head of alternatives at Hightower, may look at our report and knowing that we aren't incentivized to fundraise and knowing the extent of the background of our team, and then looking through the materials might say, okay, this is great. This is actually everything I would have done. And this is a high quality report. So now I don't have to take, months from my team to do the same thing. Either I'm going to take this and then build on top of it, or I'm going to be comfortable enough with this because I've worked with Banríon before and I know Shana, and I believe that what they bring to the table is the same, if not better than the quality that my team would produce. And so now we can expedite them through that process at least and go directly to investment committee as opposed to have to go through the whole process before you get there. The other thing we do is we provide storyboards and other marketing tools that are really intended by working with the manager to help them tell the story and make sure that the advisor is telling the story correctly. So they're advisor intended materials, but they are done in conjunction with the firm to make sure that the story is consistent and in line with how the manager thinks they should be sold. Because a lot of the problems that arise between advisor and client and manager is when the advisor tries to tell the story the way they think they understand it, and it's not accurate, and then you have a mismatch of return expectations with reality. And so we do that as well. We also are providing additional introductory aspects where a lot of advisors, again, knowing that we've done the work, will come through. And then we really encourage all of our managers to create a digital onboarding experience that is going to be as efficient and easy for the advisor and consistent for the advisor as possible. But we want to do it in a way that also doesn't make the manager's life harder. If you look at some of the competitors out there, they have their own systems where if you're a manager, you kind of you have your paperwork, but then that platform has its own paperwork. And it's meant to streamline and make it easy for the advisor, but it makes the manager's life harder because now they have 2 different sets of documents and they're not in control of the documents on the platform. Whereas in our world, we really work with the manager to work with the documents they already have and the administrators they already have and just create an interface that is consistent, coded to that. So it's not interrupting their business and having multiple different docs depending on the platform. But it is a really easy and efficient onboarding process for the advisor that integrates with their back office portfolio management solution. And that also solves what we call the custody problem, which a lot of managers run into. Most managers in the alternative space do not custody with Fidelity or Schwab. And I use the word custody lightly because it's not really custody. Whenever they say, oh, yes, I custody at Fidelity or Schwab, it's not really a custody relationship. It's really just a data feed relationship, because at the end of the day, the commingled assets are not with Fidelity or Schwab. They're custodied wherever they're custodied, BNY Mellon, JP Morgan, Brown Brothers Harriman. And they're just sending data, Fidelity or Schwab. And Fidelity or Schwab is able to show it in the account interface and put it on a statement, but they're not really custodying anything. But the advisor needs that because they can't bill a report on something if it's held away. And if it's a held away asset, then I need to be able to show it somewhere because I can't bill and report on something held away. And so we've created a structure with our digital onboarding and our portals that allow for those held away assets to, integrate with the back office solutions that they have so they can bill and report even if they don't custody at Fidelity or Schwab. For the manager, that saves them a lot of money. For the advisor, it saves them from being basically gate kept out of managers who maybe don't want to deal with Fidelity or Schwab or don't want to spend that money or have had bad experiences. And there's a variety of other reasons why it's not always optimal. Not the least of which is that a manager can't just go to Fidelity or Schwab and say, I want to be on your platform. They have to have so much advisor interest and investment already. So that means you have a very small pool of advisors you have to find that would be willing to invest in you as a held away asset. And so you have like this circular problem. Which just makes everything harder. So we try to solve for both problems the asset manager is going to have. And again, that's how we feel we earn our fee. But also every single aspect of that is about streamlining and making everything easier for the advisor at the end of the day. And everything we do for the asset manager is transferable, whether they're working with a Banríon advisor or not. The benefit to the Banríon advisor is that they can do it all in one place. Whereas if you're a non-Banríon advisor, it would just be that manager you would have that experience with, and then you'd have to deal with everybody else outside of that. So there's many benefits to both sides, but we really feel that the fee we charge is about creating an onboarding experience and a distribution solution so that when the asset manager gets to the advisor, that they have everything together packaged well in a way that's going to make it easier for them to succeed with getting business from that advisor, even if they're not platformed today. Right. Versus coming in and having to learn that process or just not even getting their foot in the door because they aren't ready. And on the advisor side, they can feel really confident in what they're getting from us because we aren't incentivized to fundraise. And that makes it so that we don't have that conflict of interest that most of our competitors have that comes from pushing product and being incentivized to do so.
That's really cool. You don't get that visiting your website. You don't get that kind of clarity as you've just explained. I think the whole idea, of course, is to streamline the process between advisors who want something that's in your platform and getting the dealer to allow them to do that.
Yes.
That's probably one of the most frustrating things is that advisors find things that they want to put in their clients' portfolios, but then they can't touch them because they're out of reach.
Yes, and our website is a work in progress, to your point. It's hard to simplify.
Shana, I'm not saying it's bad. I'm just saying I'm saying that you just provided clarity on what you do because I think that's very important because advisors might not realize that you're actually streamlining, you're shortening the amount of time it takes to get a product that they want to recommend to their clients onto their shelf so that they can actually, go to town with it if it's something that they really want.
Exactly.
Right. So, and sometimes it's also, maybe it's a client comes on who has some of these things in their portfolio already and they're not on the new advisor's shelf.
Right.
So it works in reverse as well too, right?
Yeah, absolutely. And, we have a couple of partnerships with larger firms like SmartX and Wisdom Tree that allow some of our smaller managers onto platforms because they are coming in through SmartX or Wisdom Tree, where maybe they wouldn't have had that ability if they went direct. So yeah, we solve a lot of problems. To your point, it's hard to simplify in words on a website, although we're working on it. We're in the process of doing a full redesign. But as you said, like, I think what we bring to the table is really unique. And for the asset managers, we always say our goal is to, maybe you're not going to have as many meetings as you might get somewhere else, but the meetings you are going to get, those advisors have opted in and they have all the information they need to know that they want to do business with you. So we hope to shorten your sales cycle from maybe 6 to 9 months to 3 to 6. And then from the advisor perspective, just having the resources and the materials presented to them in the way that they need them presented to make it easier to expedite through the most time-consuming parts of their process as well.
Yeah. So, I mean, it wasn't a criticism, Shana. It was more of a wow. Like,
Yeah.
you know.
Oh, it's fine. I was just...
Yeah. So, I'm curious to know how, like, when you started Banríon, like, how did it start, and how did you evolve into what you are now? Like, it must have been, like, was it through trial and error, or like, you started this process of bridging between institutions and advisors as an intermediary for all of this agnostic information that you provide. You have no vested interest, no axe to grind with anybody, just
Right.
providing the dealers and the advisors with the information they need, and providing the asset managers with the access they want.
Yeah.
Right? Like,
So
so they're coming together in your platform, but I like, it didn't start out that way, right?
no, it didn't. But I think it's a reflection of my really unique experience. And it's funny because I get asked this all the time by advisors and investors, like, well, why couldn't anybody else do what you do? And as obnoxious as it sounds, and it kind of ties back into that great intro you gave me, I think the reason why is because very few people, I can name like 3 people total in the industry that I think can bring the background, experience, and just understanding of the market the way that I can. And it's like me, Phil Huber, who's with Cliffwater now,
Yeah.
Larry Swedroe, who is now retired. And it's just like us 3. There might be a few others.
Guests. We've had them as guests on.
Yeah, no, but they're like the 3 other people that I think understand the unique aspects of both sides, because they, like me, have sat not for just a year, not just for 2 years, but for many, many years on both sides, as both an institutional allocator as well as an advisor, or in an advisory setting.
And operations.
Exactly. So
Yeah.
very few people understand, the fragmented nature of the market, which, by the way, the RIA advisory market, wealth management channel, let's call it that, because I'm going to throw BDs in there too, and everything else that's kind of in that mix. You have on one end pure BDs, you have on the other end purely independent RIAs, and then there's a bunch of stuff in the middle. That's a little bit of everything. So let's look at wealth management. Market is extraordinarily fragmented. There's people who are really good experts on, one extreme or the other, but like everything in the middle, and understanding kind of the flavors and the way that flows through. There's not many people that get that, and that's the operations part. And understand kind of like where the path of least resistance may be at any given time. A lot of managers come to us like, yeah, we want to be on the big platforms. I'm like, you're not going to get there because they're going to have this one gatekeeping hurdle. You got to get there first. So let's focus on the path of least resistance, which may not be the sexiest path, but the path that will help you get to where you want to go. Plus, if you've never had advisor investment in your product, you've always either gone direct to individual investors or institutions, that middleman, that sales process is a little different. And you definitely are going to, even if you got approved on, say, a BD and you've done the selling agreement and everything, you still got to sell to the advisors after that. Like, that's not the win. That's just the requirement.
The dealer's not doing anything.
No, nothing.
Right.
So getting approved is great, but like you still got to sell to the underlying advisor. So you're going to go through all of this like months and months and months and months to get approved. And then like it means, okay, now I can sell to the advisors underneath them, but it's not going to get you any assets. Whereas there's flatter and less resistance in other places, and just understanding that fragmented nature. But to your point, what got me started here is I do have a really unique career path that has allowed me to have a really deep understanding of areas of the market that are very complex and that very few people have expertise in. But more importantly, I had spent so much time, I would say basically from the moment I left, started at Fidelity Strategic Advisors and going on through right before I started Banríon, working directly with the REAs or the advisors themselves and talking to them without having any skin in the game as to like, just out of curiosity, like, why aren't you doing X, Y, Z? Why aren't you doing all? It's like, what is the factors here? And hearing them, because I had no skin in the game, honestly telling me like, this is why. And then having that information and having it coming from them in an honest way, because they weren't talking to somebody trying to sell them something. That really helped me.
They weren't scared. They weren't reluctant to share their gripes with you.
Yeah. So that allowed me to better understand like the problems that are out there that need to be fixed and how that impacts them operationally, business development wise, relationship management wise, all of those things. And so when I started the business, I started essentially in the beginning as like a consulting business, like, hey, I'll work with REAs and help them build alt platforms as like an OCIO. And then ultimately realized that I actually would be better served and the business would be more scalable if I provided solutions to do that, but with technology, not necessarily just me, because that's not a scalable solution. But the technology existed out there that I could work with and build on top of. That through my vision, I was able to get implemented by like communicating with tech people. But the thing that makes our tech solutions so powerful, and the reason we've been able to do it, is because I work with Mammoth Technologies for our digital onboarding. Judd Mackerel is somebody who came from Orion, but he also worked at Carson Group. And our folks that do all of our development, Dmitry Alexev, he used to be the CIO at Banríon Capital, and he used to be an advisor too. So I can speak to them in my non-technical way, and they know how to take that and build technology around it because they understand the business too, just like I do.
Fascinating. I wonder, would this have been possible? Would it have been possible for you to launch this business in 2015?
Well, I mean, that's when most of the access platforms, like I believe Case and ICAP kind of launched, early 2010-ish in that, first 2010 to 2020 area. But again, would it have been possible?
Yeah.
But I don't think there was much demand at the time for alternatives because the access was missing. And platforms like Case and ICAP really solved the access problem. But once the access problem was solved and we still didn't see assets going into the space, the question became like, why is that? And that is where we come in. And to your point, I don't know that advisors understood what those friction points would be until they had the access to begin with.
It's neat. I'm curious. I'm only asking because out of curiosity, because a lot of technology has become available in the last five years, and of course matching that up with the access. I just want that was my only curiosity.
I was building advisor-driven technology solutions for advisors in 2017, 2018. So like, it's not like it didn't exist or couldn't be done. Orion's been successful. I don't even know that it was more manual, but it was certainly being built out, looking to solve for different problems. So the tech existed, but again, understanding you had to have the access and you had to have the test case of like, okay, now we have access. In theory, assets should come into it. We know that, it's a longer sales cycle. We know there's an educational uptake. So you get a little bit of like buffer time to like figure that out. But like after, say, 5 years, 7 years pass and you don't see any meaningful uptick in assets, then the question became, well, why is that? And then you can kind of think about solutions.
So, Shana, you've done all of this. You've had all of the your career experience, and the moment you launched Banríon and up till now, and in the intervening period, you've also faced some extraordinary personal challenges as well throughout.
Yeah.
I mean, how did you keep moving forward? I'm curious to know how you kept moving forward through all of that, and what did you learn about yourself in those moments?
So, yes, understatement saying some difficulties.
Yeah.
That's
I was doing.
probably being kind. Yeah. So I launched the firm, as you noted, in 2022. I had been through, COVID and everything. I'd gotten divorced. I got laid off a bunch of times for reasons that had nothing to do with me. But at the same time, understanding that you get laid off enough in a short period of time, even if I had the best like explanation for it, people are still like, yeah, there's got to be something wrong with you. Nobody's got that bad of luck, right? But truly, and some people are like, wow, this woman attracts so much drama. I don't look at that way. I look at it as like these obstacles make me stronger. But really, it was 2023 that really tested everything. My fiancé died unexpectedly in July of that year. He just went to bed and didn't wake up, and he wasn't sick or anything to that extent. Just, it was a time, I guess. So that was a difficult hardship that I went through. And then shortly after his funeral, I started having back problems. I probably told this story a million times. And then, one of the things that's really true about our medical system here in the US is that when women have medical problems, they do not take us seriously. They always blame our hormones or stress. It's in our head. And so a lot of women find themselves like taking a long time to get explanations for issues that they're having because so many doctors blow them off. I am kind of like, I'm really not somebody who said, if I know something's wrong, I'm just going to keep going through it. So I'm going to be a badger or a honey badger or whatever you want to call it.
It's terrible. It's unfortunate that it happened.
Yeah. So when I first started having the back issues and I went to my pain doctor, because I had a doctor for some pain resulting from a neck injury I had from a car accident. She was like, it's just stress. And I didn't like that explanation. So I went to another doctor who said, well, your pain doctor says this. You think I can tell you anything different? Like, no. And so 6 doctors in, somebody finally was like, well, you're obviously in pain. So let's see if we can fix that. And then while trying to solve for why I was in pain, they found actually that there was something really wrong. Fast forward, that started in late August. Fast forward to the end of November, I find myself in the hospital. It turns out I have a tumor. It's growing in my spine, shattered my vertebrae. That's why I had all this back pain. I was walking around with a broken back for months. And everybody was telling me, it's nothing. Just do some yoga. I was like doing cat-cow with a broken back and wondering why it hurt so much. It shouldn't hurt. Well, because you're doing it with a broken back, my friend. And so eventually, tumor gets removed. I have a very difficult and high-risk back surgery. And when they biopsy the tumor, it turns out it's breast cancer. So now I'm diagnosed with metastatic breast cancer, which for those who don't know, that's a really fancy way of saying advanced breast cancer, stage 4. And then, at that point, the business became important for a couple of reasons. One, it was my health insurance. Now I have millions of dollars in medical bills. I need my health insurance. The business must succeed. And 2, I just saw somebody pass away unexpectedly at a very young age. So it taught me that like life is really short and you don't know when your last day is, and then faced like that exact scenario for myself and realized that like this is also my legacy for my son. It's like the one thing that I can make sure that he has when I'm gone. And so I became uber focused on having this business be a success because there was no other outcome that would be able to solve like the A, health insurance part, and B, legacy part. And so it actually is the thing that helped me focus on something other than my health. right? And, my doctor says this all the time. I never went into any of my radiation, any of my treatments, thinking like feeling bad for myself, looking like I was ill. In fact, day after I got out of the hospital, and some people may call this superficial, but for me, it was like, I don't understand. I went and got my nails done and got my eyelashes done and got a facial, and I had all of that done. And people were like, don't you have bigger issues? I'm like, no, because if you don't look like, if you feel bad physically,
Right.
like, and you look bad physically, you're like, you don't have anything going for you. But if I take care of myself physically to feel better, look better, then that's going to help me internally, deal with those things. And so I really did focus on that. And my doctor truly believes that that's part of the reason why I was able to um, overcome all of it, is because I always walked in like, I'm fine and I look good and like I'm not a cancer patient. I would walk into radiation and the radiologist would always say, I always cannot wait to see what you're wearing. I had a purple rhinestone cane and I would walk in like crop tops, big fur coats, full makeup, which seems like a lot. It is very extra, but when you're walking into a cancer unit, everybody there looks sick and is like very, very sad. And it feels like the energy is icky. And I had a woman walk into me one time. I walked into the radiology waiting room, and this older woman had been sobbing when I walked in. And she saw me and she kind of stopped. And I sat down and I, mind my own business. And eventually she looks at me and goes, "You are a vibe." And I said, "What do you mean?" And she's like, "Here I am sitting worrying about like if I'm going to live or die. And you like walk in the room like you own it and you don't look sick at all. Why are you here?" And I was like, "Oh, I'm going for treatment myself." And she's like, "How?" I don't understand. I'm like, "Well, like, I'm alive, right? Like, why am I going to live like I'm dying?" I mean, we all are dying, but like, you want to live for today. And it made me just value life more. And so I've gone about everything since then with that attitude of like, even when we have, being an entrepreneur and managing a startup has all kinds of, stress. And there are times where you're just like, how do I solve this? I saw a video about Elon Musk where he said being the CEO is a lonely job because by the time the problem got to you, it meant that no one else could solve it. So you only get the hardest problems. And so even in those moments, it was like, I don't know if I'm going to be here tomorrow or a month from now. So I'm not going to worry about everything that could go wrong in a month because who knows? Like literally anything can happen in that amount of time. I literally watched that happen in my own life where it didn't matter what I had plans for 6 months for now. Like I had to deal with my health issues right then and there. I didn't see that coming. I didn't see Joe dying coming. Like those things just happened and you can't plan for them. So why am I planning for something a month or 6 months out? I was focused on solving the problem in front of me and then moving on and not worrying about how that might iterate 10 weeks down the road. And so those things I think really helped me. And I think that's been able to help me have the business be successful because it's been such a focus for me to see that be successful. And it's actually helped me not get into my head, into that dark place of like, oh my God, like what's happening? Why me? I never got there. And I was able to overcome, a stage 4 cancer diagnosis. And I can proudly say to this day, my scans are clean. They do not show any signs of cancer. Do I have chronic health issues for the rest of my life? Yes. My back is compromised. My last PET scan showed my spine is crumbling. I'm losing about 2 centimeters of height every day because my spine is compromised and crumbling, which means, 7 years from now, I could be in a wheelchair. But 7 years from now, being here would be A, amazing, and B, the way medical advances happen. Like, I just watched a video the other day of a woman who was paralyzed. There's like a robot they like strapped her into that could make her walk.
Right.
So like, why am I going to worry about that? But the point being is that it kept me from being too stressed out and it kept me on a really even emotional state where I didn't get too high or too low because I had this distraction. And all of those things I think have helped me get to this point health-wise where I am cancer-free and have been consistently cancer-free now for since April of 24, so for a while. And also help me get through all that and see the business to the point it is, despite having gone through all that and despite having to run a business when I was dealing with esophagitis so bad that I couldn't even swallow my own saliva. Like, that stuff helped me stay focused on something else and never get too deep into any sort of depression. And I think that really helped me through all of it. And it's also why I have no doubt this business is going to succeed. Because if I could do all of this, get the business to here with all of that, then I can pretty much do anything. And I feel like from that perspective, why wouldn't you want to work with us? Why wouldn't you want to invest in us?
Shana, remarkable. I'm trying to decide what's the more remarkable story, the business or you. I think I think it's inspiring that you didn't allow all of your adversities to break your spirit, first of all, and second of all, that you channeled it all into the attitude that you maintain about your success and why you want to be successful, what your motivations are. I think that's very important. I think people often, they get into a business or they start a business and they reach a point where purpose was never identified, perhaps. Some people start businesses because they just wanted to make some money. They wanted to, succeed and be wealthy, and they lost sight of the purpose. But incredible story.
Well, thank you.
Yeah.
Finding purpose, I think, is the key to success in life. Like, financial success needs to have a purpose behind it, or else it's meaningless and also a lot harder to achieve because you're to achieve massive financial success, and so many people want that. The reason so many people don't do it is the obstacles to get there are so hard. And so eventually, they reach an obstacle that they just don't want to face. I feel like I faced the absolute hardest obstacles a person could ever face. And if I can overcome those obstacles, there's literally nothing business-wise that could be put in my way that would be enough of an obstacle to prevent me from continuing through.
Excellent. So how do we segue back to our conversation about alternatives? I think the you made a great point, which is that you have to immerse yourself in finding solutions to the problems that you're dealing with, and obstacles. And so, I mean, for like we're coming back to investment, like we're in this time which is really concerning. And equities are at all-time highs. They seem to be continuing. I mean, we had a little hiccup on Friday with the tariff warning, but they're at all-time highs. They seem precarious. And then on the other side, so it's hard to say, yeah, let's just continue to plow money into the S&P 500 or into stocks. And on the other side is the 40, the traditional 40% that's in the bond sleeve. And that's also been extremely trying since 2022. I mean, rates have been all over the place. Rate volatility is crazy. This seems like an optimal time for us to be having this conversation. Like, first of all, about access to alternatives, but secondly, why alternatives?
Sure.
And advisors have had a decade or more of shooting themselves in the foot with diversifiers, right? Because the S&P 500 continues to average, has continued to average 15% plus all the way through.
Yeah.
And now we've had 3 years of consecutive 20 plus returns since 2022, which was a year that sort of identified the problem that portfolios are not adequately diversified.
Yeah. So I think first we have to remember what alternatives are. Private equity, private credit falls into alternatives, not because they are alternatives from a diversification, but they're alternatives from a public-private standpoint. But you got to look at the universe of alternatives in like their different subsegments, right? So you got the liquidity alternatives, which is your public market versus private market conversation. But in a portfolio, there's still equities and credit. There's still equity and fixed income. So they're not diversifying alternatives. And so that's a different conversation to have with clients. It's more of a, are you comfortable with illiquidity, and are we getting enough alpha in return for that illiquidity? That's a conversation to have. Sometimes the answer is no. And then there's the diversifying alternatives, which are risk management tools, but also there's a lot of stuff that falls in the diversifying alternative bucket that are just poorly defined in any clear like equity fixed income bucket, but may correlate to those things. So
I think Makita had a really great paper that we just love here, which is risk mitigating strategies.
yes, and
RMS, their RMS framework, because in that they said that, using the term hedge funds is like saying sports.
right, but also hedge funds are by definition what their name is. They are hedge funds, meaning they are meant to hedge. And so they should never be treated by and compared to something that is unhedged. But again, hedge fund strategies can now be available in ETF form and mutual fund form. I don't really love them in interval fund form, but yeah, sometimes in interval funds. Crypto falls into the alternative hat. Like there's all kinds of stuff that falls into this bucket that can work in different market environments, risk on, risk off, real assets, sports is part of the PE, but I would argue that it's outside of traditional equities and can be a diversifier. So there's all different ways to have the conversation. There are things we know, though. CNBC has been doing a lot of research into the wealth management channel as it pertains to alts. And the one consistent thing that they've seen is time after time when they talk to individual investors, this is stuff they want access to. So advisors, if you're not bringing alternative solutions to the table to your clients, they're getting them somewhere else. They're looking at them somewhere else. They're maybe even investing on their own. We found that to be true, significantly true with crypto and younger clients. And so you have to be open-minded to those things. And you also have to think about like, how well do you know your client? And that gets back to where we started the conversation. Alts are really a relationship management tool. And that's how we build out our solution here, is to make them part of getting to know your client better and being able to bring to your client something that they're not getting from everybody else, that shows them that you understand who they are and what they find valuable. We know clients want alts. We know that access is no longer an impediment. We know that structures now exist that make alternative solutions available to clients, whether they're accredited or not. Finding the right solution and filling each one of those buckets is the key. And as far as I know, Banrion's the only place that is structure agnostic and open architecture and willing to have those conversations and help the advisor have those conversations about liquidity budget, illiquidity alpha, all of those things and where things belong and how to use alts as risk management. I say this all the time, it's a broken record, but we teach advisors how to build equity and fixed income portfolios, but we don't teach them how to build alt portfolios. So they choose a single alt and say, well, that's it. And then it's not enough to truly diversify. You got to build your alt portfolio in the same thoughtfulness that you would build equity or fixed income. So it's not a single product solution. You got to think about how you take a couple of different things and put them together. That's why we work with SmartX and Wisdom Tree. We build them alt models because they recognize the value of that, and they recognize that there's very few people that have the experience and the success building those that we have. But we do it structure agnostic. So we can do it with ETFs. We can do it with interval funds. We can do it with private products. Finding the right solution for your client is important. And so all of those things matter. In markets like this, there's more opportunity than ever. And the more cookie cutter you get, the less you're actually building and growing relationships with clients and standing out from your peers. So we're here to help you look at ways to manage risk without sacrificing returns, even in up markets. I can make the case that if you do alts correctly and you sleeve it and position size it correctly, it's not going to deter from your overall portfolio returns. If anything, it'll potentially make them slightly better with less risk. And you got to look at it from the holistic full portfolio view and not everything in a silo. And I think clients appreciate that.
Absolutely. I mean, the ultimate objective of adding alts to a portfolio is to build resilience, something that you are very familiar with.
Yes.
And I think, but resilience, and obviously without losing sight of return, it's not just about risk mitigation. It's also about, having a portfolio that has a better long-term outcome for better compounding, for more efficient compounding, and also tax efficiency, and, a laundry list of other objectives. But the point is that a lot of advisors are reluctant because of, number one, the conversation risk that they are maybe avoiding having with clients. But there's career risk, there's tracking error. They're worried there, and maybe because they're not entirely familiar with a lot of the alternatives that they should be looking at, or could be looking at for their clients' portfolios. They feel, because of that unfamiliarity, that it's possibly introducing more risk to their portfolio, when in fact, ironically, the risk is that they're not.
Well, they've also probably been burned as well.
There's
almost certainly been burned.
That was kind of to the point of what it was like to diversify portfolios into alternatives the last 10 plus years.
Yeah.
When stocks were racing forward and bonds were continuing on their trajectory to zero interest rates. Now we've had a reversal of that, though, right? We're in a new regime now where rates are going to be higher for longer. They're not necessarily high, but they're going to be higher for longer. They might go higher. Like even a rate cut recently led to higher yields in the 10 and 30. Yep. 10 and 30 U.S. Treasuries. So, wow, big surprise. The term premium, crept back in there, and people expect to get paid more for those maturities. But the duration risk of doing that is enormous.
Exactly.
Right? I mean, people have been piling money into TLT for years now, and they're still losing money, and they're still piling it in with the idea that that's an adequate ballast for their portfolio.
Exactly.
That somehow long-term rates are going to reverse. But what if they don't?
No, exactly.
What if the debasement and monetary concerns and fiscal concerns that are in the bond market, that are priced in the bond market, continue to lead to higher yields? Then those traditional bonds are no longer the traditional ballast that they once were. So not doing something alternative, something different to complement those assets that you want to keep on holding is actually the bigger risk.
I agree.
Substantially the bigger risk. So, what are you looking at? Like, Shana, like, we talked about the knowledge transfer problem in the industry, the disconnect sometimes between institutions and dealers, or institutions and advisors, because of the perspective, the mixed perspectives. We've talked about, how, like, I do want to get into the storyboarding aspect of what you do. But before we do that, I want to know, I want to get a sense of what it is you think are the kinds of alternatives that are not only like getting a lot of traction right now, but what are your favorites? What are you really liking? Like, you're looking at the whole alternative market. What stands out to you as something people are potentially missing the boat on? Like, and what are your favorites?
So a couple of things. Let's start with private credit, which is really popular right now, right? So the biggest problem with private credit in the wealth management space is people are going into the big fish. Not that I think Apollo or Blackstone does anything bad, and that they're not excellent stewards of capital when it comes to private credit, because I do. But when you're playing in that upper market of credit, right, it's a lot of money flowing into a very small opportunity set. So the value add is not there, and the deals are not necessarily being priced in a way that is advantageous, right? The opportunity set, if you have 50 deals, but you have billions of dollars chasing after those 50 deals, you're gonna not necessarily get the best terms for the investors and the funds. And so in the lower middle market, though, it's a different story. Like we have a client, Meriwether Group Capital, and we have that stands out. Like they are lower middle market. They do loans between $1 million and $2 million. Very focused on asset heavy, very specific to the Pacific Northwest. And they see about 150 deals a month, and they do maybe one. And so in that lower middle market tier, access to capital for smaller businesses, for startups like ourselves, who like the venture world has been tough to say the least, especially in that seed stage, Series A, pre-seed stage. We need to access capital elsewhere. And so you go and you look for alternative capital lenders, and that private credit market can be really interesting, but there's not a lot of players in the space. There's not a lot of money in the space. And so finding and deals and capital in that space is hard as a business, but for the managers in the space, they have tons of opportunity. They're not rate sensitive because they can charge whatever they want because access to capital is so difficult. And so that area of private credit is really interesting, but that's never the area that we talk about, nor is it the area where most of the opportunity that is being pushed to the wealth management channel is. Let's talk about sports, right? So sports falls under private equity, but sports is kind of its own thing. It's very early innings of the opportunity set. Emerging sports and changes into media and how we consume media has resulted in tremendous opportunities in emerging sports in areas that before maybe didn't have great returns or people any interest whatsoever. But like WNBA is a perfect example.
Right.
Very early innings of that development into something where the returns are pretty phenomenal. And you think about go to Netflix and then look at all the sports documentaries that are there or the sports related docuseries that they do. It's not in sports that are like football. It's in like F1. It's in golf. It's in other areas. And the media pays for the rights to that. And that is a key area of growth and opportunity and return on investment for any kind of sport. So there's that. There's this growing competition where you have the NBA, but you also have the 3-on-3 leagues and flag football leagues now versus the NFL. And there's just so much opportunity there. So, those are some areas that are very visible that people are talking about a ton. But then you get into your, I'll call them boring, but the more complex stuff that's more diversifying. So I was at a conference last week where they talked about nobody likes managed futures, and they didn't like managed futures. But managed futures as a diversifier in a fully thoughtful, put together alts portfolio actually makes a ton of sense. Like I would never use it as my only alt because it is negatively correlated in isolation. Right. It is a difficult thing. It is definitely an asset class that's going to give you headaches because your client's going to have a lot of questions, and it is complicated to explain what managed futures are. But in a holistic view with, say, an equity long short that's directionally long, or a hedged equity product, not a buffer. I don't like buffers. Or like managed futures paired with crypto is actually a really interesting mix because they are not correlated to each other in any way. They almost are perfectly negatively correlated because if crypto's ripping, managed futures probably isn't, and vice versa. Right. And you look at market neutrals, you look at real assets, you look at alternative versions of real estate, not non-traded REITs, not publicly traded REITs, but more like real estate debt in an interval fund form, venture capital in the seed Series A. There's some interval funds coming out in that space as well. And all of those things can be really interesting. And when you put them together in a diversified portfolio, there's real ability to add alpha and not detract from your portfolio, but you also have to be careful how you do it. So there's this whole concept of return stacking that's becoming very popular.
Right.
The work that we're doing with Wisdom Tree is based on this premise of return stacking, where it's a 90-60, where there's some use of leverage and leverage can be good or bad depending on how you are realizing that leverage. Leverage is, getting a mortgage to buy a house, but leverage is also using and juicing up a portfolio by like selling a ton of options or like really levering up options by borrowing money to do that. And that can be a higher risk, but a higher reward potentially as well. So this return stacking concept of 90-60 says, if you do this and you use a little bit of leverage with your traditional 60-40 to then go and buy 20% in alts, you're not giving up any return of your 60-40, but you are gaining some risk management diversification through alts. And then if you build that alts portfolio to be well-rounded and well-diversified and really thoughtfully do it, then you can really bring something to the table. And that's how we're working with Wisdom Tree. One of the reasons why Wisdom Tree wanted to work with us is because they asked me, what my ETF model of alts had been doing. I'd been running it since my time at Orion. The performance is actually really good. And I won't throw numbers out there because compliance hates that. But I will say that the one thing they noticed was like, wow, this is like close to market returns. Maybe not the same extent to the market, but not substantially like less. Definitely better than fixed income.
Like de minimis.
Right. Definitely better returns than fixed income. A lot less risk. Throw it in there, and all of a sudden you got something really interesting. And so, that's how we kind of think about alts. That's where the opportunity stands. That's where I like alts right now. Like, I love talking sports investing because my background is in sports management and I love sports. I love talking different aspects of private credit because people don't always see the nuance and, where private credit opportunities lie. But I also think that really the best way to play alts is to think of them as just another sleeve of your portfolio like fixed income and then build accordingly. And you can actually get the most juice out of that more than anything. It's just the hardest part of alts to do. And our industry doesn't do a great job providing resources and education in that space because, quite frankly, I think a lot of the people who provide ratings and research into product categorizations actually don't understand the product any more than the advisor does.
Right. So they're miscategorized.
So they miscategorize or they don't categorize them well, or they throw everything that involves options in a single bucket, even though 10 million different ways to use options and they all can be used for either adding risk or taking risk out of a portfolio. It's like, there's a million ways to do things. So all of those things, I think, make it difficult, but it's actually where I think the best opportunity lies today, which is why I'm excited about what we're doing with some of these partnerships.
There's never been a more challenging, but also maybe disproportionately exciting time to be an advisor. There are so many opportunities to do incredible things with wealth management that were not possible just 5 years ago.
Yeah, I mean,
and it's truly remarkable. Like return stacking, you mentioned return stacking. I mean, using capital efficiency to maintain a 60-40 exposure, for example, while adding on top of your existing 60-40 look through another 5, 10, 15, 20% into other assets that don't interfere with your traditional allocation. It is an exciting concept. It's something that institutions have been doing for a long time.
Yeah.
But now it's available, return stacking is available to everyday investors through ETFs.
Right.
And that's remarkable. I think that, if you want to build resilience in your clients' portfolios, you have to continue the search. You've got to keep looking. You have to keep being curious, keep probing, keep looking for solutions that actually solve that problem. I remember, in the late 90s, asking the wholesalers I was dealing with at the fund companies, like, do you guys have anything that can offset all these gains that we've made leading up to, late 99, 2000?
And none of this existed. Nope.
The answer was no. There was nothing. Like, am I going to have to go and take some long volatility risk in the market or write some, buy some put options against the market? Like, am I going to have to do that manually? Or do you guys not have a solution? You guys have had 400% gains in the last 5 years, in this, it was a particular sector. And a big sector, important sector, but and then for compliance reasons, I won't.
Everybody knows what sector you're talking about. It's all good.
Yeah. So, but there was nothing for risk management unless you had not only the knowledge to do it manually in portfolios, but you had to also get your clients on board to do it as well. Otherwise, it'd be like, forget about it. Like,
You also had to have licenses to do it. The independent RIA space wasn't really as large as it is today. Like when I started in the business, I was a stockbroker. Even though I never viewed my job that way, and you never hear that term anymore. I worked for a broker-dealer, and by definition, a broker-dealer is brokering, selling securities. And that's different from an RIA.
bad rap.
Yeah. And I just think that, the entire business change, even the compensation model for advisors is evolving. It went from the broker-dealer where it was all commission-based, and then it became AUM-based. Now it's service-based, and I am hearing more and more of it referred to as a financial coaching, where you pay a fee for the coaching. So the model's changing, which means, the way we approach things have to change, which means the solutions have to change. And I think all of those things are happening today. And some of it has to do with changes in regulatory environment as well. Like a lot of these products couldn't exist pre-2007 because the regulatory structure did not allow for it. And the regulatory structure has evolved, 2007 to allow leverage and shorting and in a major way in mutual funds, then 2019 with active ETFs, and now with interval funds. And so it's constantly evolving, but now these solutions are out there. Technology, as you pointed out, for tax efficiency and being able to build custom direct indexing or tax managed portfolios and SMAs, that exists, and it's easy to do on the advisor level. So all kinds of solutions out there that, even 20 years ago were even something you could consider. And that is a good thing for the underlying client. We talk about the democratization of alts, and we talk about, the class, how the rich are getting richer and the poor are getting poorer. But I would argue that, we now have more people than ever that actually are paying attention to the stock market because of 2020. And are learning and understanding and want to be involved, and access has become flatter. And so really, advisors should view that as an opportunity, not as something that they're scared of. And I fear that most advisors are scared of it. But they shouldn't be, because there's firms like Banríon that exist that help them through that process and can, be there for them and hold their hand. And, that's really important. That didn't exist, 5-10 years ago. But ultimately, access has never been flatter, so there's no more excuses that this product can only be sold to if you're rich.
Right.
But now the problem is not access; it's education and willingness. And if we know that if you're not doing it, that individual investors are doing it on their own and probably poorly. So there's a real opportunity here, and that's the thing that we should be focusing on.
Right. So, Shana, we talked about advisor education. Institutions, dealers have to pick up the mantle on getting advisors on board, make the effort to get advisors on board with alternatives and understanding, that there's not every advisor is going to be interested, but for those that are, that's the first hurdle. The second hurdle, or big hurdle, is advisors might be reluctant to present alternatives sometimes to their clients because they're afraid of the communications or the potential for miscommunication, confusing the client, making the client sort of feel, is there something I should know about that you're not telling me? Besides, what do you actually? And I think sometimes, and you want to do it while the sun is shining. Like right now, with the stock market at all-time highs, there really isn't a better time than, in this period, in a lead up to what is probably an inevitable correction at some point, to start to actually, I mean, the best time was a few years ago, but the next best time is now, right? Yeah. How are you helping advisors with the communication hurdle that they fear or they're reluctant to engage in their clients? Like, you've created storyboards.
Yeah, the storyboards are a great example where we literally lay the story out for the advisor. And we work with the asset manager to lay that story out so we know that it's being communicated correctly. It's a 1-page, the template's the same for everybody, but it's the pure, like, the minimums, the fees, the lockups, all that good stuff. Who qualifies. Then there's the why this now, why this product now, and then like the details of why that product now, meaning what they're investing in and how to tell that part of the story. And so it's a really easy thing for advisors to use. And then our due diligence reports, as I noted, we spend the last page of every report walking through the investment case, like the why, but then the very last part of every one of our reports is the key considerations part, where we talk about, you want to have this conversation with your client, you want to have that conversation with your client. Here's a nuance to this product that you should know about. For example, we just wrote one recently. I won't mention the manager, but I will say that the manager is a fund of funds structure, right? But it's not a sub-advised structure. And while that might not seem like something most people would catch, it's an important caveat. When you have a sub-advised structure, having built in managed funds that had sub-advised structures, when you have a sub-advised structure, there's a separate account, right? And it's my account. So it's, when I worked at Mercer, if we hired a sub-advisor, the sub-advisor was managing an account that was Mercer's account. So when we wanted to stop using the sub-advisor, we didn't have to worry about liquidity terms or, notice periods or whatever. We just shut off their access to the account. Right. And then we hired somebody to liquidate the account or bring it and convert it to the replacement account. And the name of what those folks are called is transition managers is what we call them.
Right.
And we would hire them. The amount of times I did RFPs for a transition manager for making that change is like many, many times. But the point being is that when you have a sub-advisor relationship, you can cut off access at any time. That's your account, you own it, and you can be responsible for making that transition out of it, making those replacements. When you are not using a sub-advisory relationship, you are in a commingled vehicle with every other investor. You are subject to gates. You are subject to liquidity terms. You are subject to notice periods. It is not that easy to get out of. You don't have that kind of control. You can't just transition when you want. And that little caveat matters. And so just being aware of it is important. And so like that's an example of something we put in the key considerations is say, hey, just an FYI, it's a fund to fund, but it's not a sub-advised relationship. So just be aware. And then, things like liquidity terms and having a liquidity budget conversation and how do we have that, tax consequences and understanding in a real estate fund, the difference between return of capital, depreciation related income versus, capital gains versus dividend income. All those nuances matter, have different tax consequences and tax treatment. And so understanding that and having those conversations. So we really help the advisor, know what conversations to have ahead of time to make sure suitability is there, but also like understand how to tell the story. So now you are properly aligning return expectations, which, more often than not, mismatched return expectations cause the most problems.
That's critical.
Yeah, when I worked on the institutional side as an institutional allocator, I always used to say nobody gets fired for underperformance. People only get fired when the performance doesn't match expectations. That is the key to being fired. If I know why you're underperforming, then I'm not concerned. But if you are underperforming because you're not aligning to what you set as my return expectations, that's a problem. I have been in a situation where I fired a firm for outperformance because their outperformance was based on implementing investment strategy that was outside of the expectations and why we purchased them and why we were investing in them. And so I fired people for outperformance as much as I've fired people for underperformance. But more often than not, I never fired somebody for reasons related to performance. It was always related to some sort of operational risk, compliance risk, something of that nature. And it should be the same with what you invest in for your clients as an advisor. But that only can occur if you understand and set appropriate performance expectations.
And if the advisor's role is, understated, that it's really, they're really managing a relationship, if there's a mismatch between expectations because you miscommunicated a fact, you miscommunicated an outlook for return.
That's going to get you fired.
Anybody in the business is going to say, well, the first thing out of the client's mouth is going to be, why did you told me this and I got that?
Yep, you're going to get fired.
And under promise, over deliver. That's really right. I mean,
exactly.
Better to under promise and over deliver than to over promise.
And also, when you look at it in that light, the complexity goes away, right? Because it's really not the complexity that's the problem. It's the return expectations that's the problem. And so when people and your clients start asking about, why this is performing the way it is, if you understand and have correct performance expectations, you don't actually have to get into the weeds of the complexity. You just can talk about everything and as it relates to performance expectations. So if it's underperforming because it's managed futures and managed futures tend to underperform in certain markets, that's your answer. It's not, well, they're doing derivatives and they're making bets on currency and they got the currency bet. Your answer is more, no, this is aligned with the expectations we have for a strategy of this type. It should be doing this during this period of time. And that's your answer. You don't need to bring the complexity into it. And the second you do, even if you do understand it, the client probably doesn't, and you've lost them anyways. So again, if you can set correct return expectations, it makes that conversation very simple and easy. We knew it was going to do this at this time, or we didn't. And if we didn't, that requires me to do more work. And hopefully I will have done it ahead of time. And that will usually get the manager fired, not you, because now you can go in as the authority and being like, you know what? This is not performing in line with our expectations, Mr. Client, and for me. So we're going to move out of it. But now you're selling it for those reasons and not because your client freaked out and you didn't properly align expectations. Everything I did as an institutional allocator was about making sure I understood how this fund should perform in certain market conditions. And when those market conditions arose, I didn't have to do a lot of work to understand why it was performing the way it did. I could answer that question because I understood at its core, what drove returns. And that's what we aim to do in our storyboards and in our reports, so that makes that conversation easier for the client and for the advisor. The answer doesn't require a lot of homework if you understood those things to begin with. It's really about setting appropriate return expectations time and time again. The conversation gets complicated when you didn't do it right, and then you try to explain your way out of it, and we don't understand the underlying.
There's no amount of backpedaling. There's really no amount of backpedaling that you can do that's going to get you out of that mess.
Exactly.
I love the storyboards. I think the idea of the storyboards, I think that's an idea that would be incredibly attractive to advisors. And it's a starting point, right? I mean, it gets you into the right frame of mind for each and every alternative that you're considering working with.
Exactly.
And then obviously beyond that, you're, it's entirely up to the advisor, up to you to go and dig deeper if you want for your own knowledge. But in order to transfer all of the, just broaching the conversation to begin with and with the correct frame is important. But making sure that all the guardrails are in place of expectations is critical in terms of the long-term outcome. Because if there's a mismatch down the road, like you said, there's no amount of talking your way out of it.
Right.
You said this, I got that. I don't like what's going on here.
Yep.
But if you can avoid those traps, which are, if you think about it, those are really the traditional, sales traps,
right,
where you overpromise and underdeliver.
And managers in the alternative space want that messaging to be done correctly anyways. That's why we work with them to create the storyboard. We want them to be deciding what hurdle they want to be held to, right? So
liquidity, return.
They're making sure that they're kind of driving this is exactly how you should consider us and what you should expect from us. And if we're not doing this, then you should fire us. But they know better than anybody what hurdles and what they're trying to achieve and how. And so that's why we work with the managers to create the storyboards. But it's meant to be a tool for the advisors to set and communicate return expectations appropriately with clients. But it's also a great resource tool when things do go wrong, because then you can look back and be like, oh yeah, that's why we own them. This is what we expected, and this is what's in there. So yeah, it makes sense that they wouldn't be doing well at this time.
This is what I said to you.
Mhm.
This is what I said to you. This is what I wrote to you. This is exactly the guideline that
We said.
that we agreed on,
Yep.
that we agreed upon. Shana, I think the work you're doing is incredible. What kind of mark do you hope to leave on this industry and on the people you work with?
Well, I think it might be a little lofty, but I hope that what we're doing here at Banríon is really the thing that drives forward adoption of alternatives. And I hope that, 10, 20 years from now, when people look back and they see right around the time Banríon launched and grew, that we started to see this transformation and the wealth management channel and alternatives, and that Banríon was, the leader in making that happen. And, again, it's a lofty goal, but if in 20 years from now, that's what I'm remembered for, then that is exactly what I'm trying to achieve.
It's a good one. It's a good one. Shana, thank you so much for your incredibly valuable time and your insight, and for sharing your story. I think, your personal story is, uh, I wouldn't say equally fascinating. I think it's more fascinating what you've been through, and, more incredible that you have, um, that kind of resilience behind you, that you didn't stop looking for solutions. I mean, you could have easily just sat down and taken a back seat to your own health, uh, taking it for granted, but you didn't. And I think that's an inspiration to advisors, as well, whatever they're going through, but also practice wise, it's an inspiration to advisors to, never stop being curious, never stop searching for solutions, never stop looking to do what you're doing well better, and what you're doing poorly well. Um, I think that, it's very easy to take your knowledge for granted. Um, and so much has changed. Our situations have changed. The market has changed. The economy has changed. The way things are happening in investment, is changing, if it hasn't already changed. Um, so, Shana, wonderful to have you, and I'm glad that we were able to spend time on both.
Absolutely. Thanks for having me.